Relaxo Footwear's Q3 FY22 result was affected by steep rise in raw material prices and additional margins offered to channel partners owing to increase in GST rates from Jan 22. Sharp increase in input costs would affect margins in the near term as price hikes taken by the company would reflect with a lag. We expect margins to recover in the next fiscal. Long-term opportunities continue to be robust as seen in the company's recent announcement of capacity expansion as it looks to enter into new untapped markets. Market share gains from unorganized segment also remains a key trigger. The stock has corrected by about 27% in the past 4 to 5 months, underperforming the Nifty which has dipped by 4% in the same time period. We turn positive on the stock post the correction and believe the current levels provide a good entry point for investors given the robust long-term prospects. Relaxo maintained double-digit revenue growth in Q3. Top-line growth was led by increased realizations which grew 22% YOY. Price increases owing to higher raw material cost and a likely better mix led to better realizations. Volumes were under pressure with the company selling 4.5 crore pairs which is a 10% YOY decline. Gross margins declined sharply by 570 basis points on a YOY basis due to steep increase in input costs. Relaxo offered additional margins to channel partners to neutralize the impact of increase in GST rate from footwear from 5% to 12% with effect from 1st of Jan, which also affected the gross margins. EBITDA margin decline was in line with the drop in gross margins. Net profits meanwhile dropped 22% YOY. India has witnessed a sharp reduction in COVID cases since the end of February. Furthermore, we've reached a record number of vaccinations and also seen commencement of vaccination for children aged between 12 to 14 years. State governments have removed most COVID-related restrictions and the operating environment has come back to normal. Relaxo has enhanced production capacity quite recently. The company has put up additional capacity of 1.5 lakh pairs every day at its existing plant in Bhiwadi. This has led to a capacity increase of about 18% on an overall basis. Relaxo's overall production capacity has increased to 10 lakh pairs a day. The capacity increase will continue to drive the growth momentum for Relaxo. Relaxo has strong presence in the northern markets. The company is expanding reach in the unexplored areas and strengthening presence particularly in the west and south. Recent capacity increases in Rajasthan will enable the company to gain foothold into the relatively untapped areas. Unorganized segment forms a significant chunk which is about 2/3 of the overall footwear industry. With customers shifting towards branded segment and with branded players enhancing capacity and reach as well as GST reducing the competitive edge of unorganized players, we expect the share of leading organized players such as Relaxo to move up. Both rubber as well as crude prices have been on an uptrend over the past 6 months which affected Relaxo's operating margins in the past 2 quarters. Relaxo's gross margins declined by about 400 basis points in Q2 as well as Q3. Also, the GST on footwear, which is of less than 1,000 rupees, where Relaxo has a majority of its portfolio, has been increased from 5% to 12% from the 1st of January. However, the effect of GST increase is expected to be marginal as footwear industry had an inverted duty structure and raw material were already taxed at 12% earlier. So net price hike on account of GST increase is expected to be marginal. Also recently, rubber prices corrected by about 10% from the highs seen in November 21. However, crude prices have moved up significantly, about 40% in the last 2 months, which would continue to put pressure on the margins. While Relaxo continues to take a calibrated price hike, it would not be possible to pass on the entire increase in the near term, which would affect its margins. We expect Relaxo's margins to recover in FY23. At the current market price, the stock is trading at a PE of 59 times its FY24 projected earnings, which is close to its medium-term historical averages.